Yeah.
Hello.
Hey guys,
Hey,
Hey, this is Valley. Carl, whatever way you want to call me.
Carl. That's a great name. I like that name.
how do you
Alley's
want to be
good.
called? It's the rule of Discord.
That's right.
Phones. Hey, did I just screw up my voice?
Nope, you're good.
Is it still working? Okay,
Looks like it. Something.
on headset.
I don't know if I need to show anything. I think it worked last time, but maybe.
So I did test out the recording functionality on this machine, and it seems to be all right. Sound is coming through clear from you guys, and I think we're okay. We're good to go. If you want to start us off, or if you want to wait a bit, we can wait until more people join in.
Yeah, I don't care. We can get going, and I mean, there's no structure, so we can jump all over wherever we need to be. So
Being the usual suspects who would be interested in this. I forgot who expressed some interest.
Well, you had the
think
best
the
yeah, well, I
questions, I
had a
think,
list.
right?
Yes,
Um,
I'll shut up this time and I'll let other people speak. Or at least I'll try.
Well, why don't you can start with the one question you had, and then if nobody else speaks up, go ahead and keep asking.
Okay, okay, well, just for the record, it was not my idea, okay? So I'll talk because people asked me to. Um, One question I had is if you can give some sort of at least some primer about the calendar spreads. Like I never actually tried to do anything calendar. Well, besides like a typical role, which is technically also a calendar. But like what
Okay.
you did, for example, right now for Delta, I think, like
Yeah, I
earnings,
did.
but not necessarily for display, but in general, like how does one typically think of a calendar spread?
Okay. What a calendar spread, the way I use them, is to use the increase in implied volatility that happens right around the earnings time. So I short right after the so if I got an earnings period, I want the option strike that's just after the earnings date. So Delta reports early next week. So doing their weekly, I short the Friday of that week. That way I get the biggest amount of IV increase. And of course, when you do that, you have the risk that the big move's going to happen because of earnings. So by shorting, you're kind of opening up your door to the risk. But what I do is if I go out any amount of time you feel like. In this case, I think I went out 43 days. I bought the option. So really what I did is I created a short spread. All I did is put some time in between the two strikes. It does a couple things for me. One, if the stock does not move up, then almost all the premium will come out of the front end, the one that expires next week, the one I'm short. That will give me all of that premium back. My one that's out 43 days will be adjusted by a few cents in theta, but nothing else really will affect it. I could technically close the entire trade. So really what I'm doing is I'm short the call option without any of the upside risk. The long dated call is protecting my risk in the event we get a runaway to the upside. So I get the advantage of the IV bloat. I get the IV crush on my option, my short option. I protect it with my long option. Now I either can close it for profit, or if I've got no value in the front end, I could roll that again the short side and keep collecting premium, which is paying for that long option. So if I got a slight bullish movement on Delta Airlines, then I can stay in that position. And by the time I get to 43 days out, I may have already paid for or already made a profit just by selling the short side of it. And I'll just keep rolling it out every week until I've collected back everything I've paid for the long side, hopefully plus profit. If I don't get there in time, then I can just roll out to one above, so I can shift it one. And now I've got on 43 days, whatever days are left, I think that makes sense. 43 days, I will now have a debit call spread. So if I'm still above my long dated long option, I've got a profitable call spread. So I'm utilizing so I'm using the long date to protect my short date. Does that make sense?
Yes, yes, it does. I'm trying to see what to wrap my mind around what you do if the delta goes shoots up very high. You said you were doing this on call side or what side?
Yeah, I'll get the oh,
I think
yeah.
you did this on call. I'm just trying to
I did it
see.
in calls. You can do it in puts. It's
Yeah,
really, I mean, I'm going calls because I'm thinking that Delta's moved upwards in the last few days. It seems to have kind of an upward
right.
bias to it. If I look at all the
Uh-huh.
triggers, I think I've got a weekly two up. I may be wrong on that. I'm just going by
Uh-huh.
memory. I'm going to say that I got a long buyout. So therefore,
Yeah.
I did it in call. I've got an 8-day 55 call short. And I got a 43-day 55 call long.
Oh, you
Did
did
it
the same
for
strike.
like what, a 70-cent debit? I think that's what it was, 70-cent debit. Now all I only have to do is roll my short side probably once, and I'll collect back my 70 cents. Then I could either get rid of it and I just have a single long call option 43 days out, or I could roll it again and collect more premium against it. So what I'm using is I'm reducing my buying power required because right now that requires capital required. Oh,
Oh, it shouldn't require
yeah, that's
anything.
cap required. Cap required is, oh, it doesn't even show it, but it's nothing. It's like
It shouldn't
it's like
require
the cost
anything.
of my option. Yeah, it's like
It's
70. It's like the 70 cents. Whatever my debit was is my capital required.
right,
It's
right,
really
right.
correct. I'm not. I'm spent money, so it's not really using any margin
Yeah.
per se, but it's a cost.
So
So go ahead.
yeah, so actually, I now that you told me that you're actually doing the same strike and so you're paying for it, I guess if it goes, so if it doesn't go to your strike, you end up, you can't really, you end up losing money, right? Because
Not
that,
necessarily, because I can keep rolling the short side because I've only got it on for 8 days. I got 43 days. I can roll it another week, pick up another credit, roll it another week, pick up another credit. So if it never
mhm.
hits my short strike, then I'm going to pick up 70 cents this time. Then I'm going to roll it again. Maybe it'll pick up because I don't have the IV. I'll pick up 50 cents. But I only got 70 cents to have to pull back. So two rolls, and
Ah,
I've paid for
okay.
this trade. And now I've got a free call.
Yeah, 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 okay, makes sense. Got it. And so, and if it goes way up, then like if it goes past your strike, you're saying you will try to roll the short one out and up so that you end up with a
Correct.
with a debit spread.
With a regular, or
Ah,
whatever they call them,
yeah,
long call spread or bull
yeah,
call spread. I guess that's the typical old name for it, bull call spread.
yeah.
I don't know if you have any visuals,
Yeah.
Ali, but
So I got many options I can do with it. I can roll it out. I can roll it out. I can put it into a butterfly. I mean, I got many, many things I can do with that. The idea is that I can end up with profit almost immediately upon earnings. I can end up with a adjustment I have to do to make profit. I can adjust it into a positive call spread. If I'm running out of time and I don't have enough room there because I have very little cost, I can butterfly it right out on the end, which would be for credit. There's 5 or 6 adjustments I can do to that trade. But essentially, I've created a bull call spread, but I've put time between the two strikes, giving me ability to roll my short side and taking no buying power. If I just short a call and not put the long one on, well, now I've got a $50 stock that can, I mean, technically can go up
Yeah.
forever, and I've got unlimited risk. But this way, I've capped my risk, which then capped my buying power. And that's why when I don't know how many here have noticed, but I mean, I'm carrying 60, 70 positions open right now. Well, if I've only got $70 tied up in a position, then it's not that you can see that I mean, it sounds like, oh, he's got 60 positions. He must have a ton of capital involved. Well, I got such a small percentage of the capital I have available engaged because I use strategies like this by using the short side to pay
Mhm.
for the long side.
Yeah, that makes sense. How do you actually, if you have like 60 positions, regardless of how much capital they take, how do you watch all that? Like you end up watching what 60 tickers? That's a lot.
Or
What
I
do
watch
you,
320 tickers.
okay.
What I've
Like,
done is I put them all in a spreadsheet, and that triggers me all the two ups and two downs. It queries a list, so I get one list of ups and one list of downs. So the only stocks I have to look at on the chart are two ups and two downs. The rest I forget because if it doesn't giving me a two up or giving me a two down, I don't have any interest in it. So it
on
doesn't
this
matter if it
time
was
frame.
inside, it doesn't matter what it is, it has to break above or below the prior candle. If it does that, it goes on a list. Those are the ones I look at. So I filter my high volume option stocks, which I've found to be about 320 right now. I
Mhm,
filter them to ones that, got good spreads, got weeklies, got different parameters. That's what my
mhm,
list is. And then I'm looking at anywhere from 2 to 30 stocks of that 300 on a given day. And all I'm doing with that list is trying to find what am I going to do today. So my 60 or 70 I'm using to manage. All I got to do is look at them and say what's in the money, what's profitable, what do I need to do, what roles do I have. So that can take about 10, 15 minutes a day to manage the 60 that are open. And I'm going to look at my spreadsheet list and say, here's the stocks that went two up or two down. I'm going to look at them charts to see if there's anything I like. And then I go to the options chain, try to find out what fits my parameters, my own mental parameters of an acceptable
mhm.
trade. If I like it, I put it on. So, I mean, I can miss a day, I can trade for 10 minutes a day, or I can trade for 8 hours a day and just sit there and go over charts to my heart's content. So really
Yeah.
very flexible and quite easy because I'm letting technology do the work for me.
And thank you. And then when you say you're looking for top to down, that's on a daily time frame?
Say that again? Yeah, top to
When
down
you
on daily. Yes, yes,
daily,
daily.
okay.
Well, my spreadsheet
And,
picks out monthly, daily, weekly.
mhm, mhm.
So I could do it on weekly, I can do it on monthly. And so I'm
Got it.
picking out all the two ups, two downs, daily, weekly, monthly,
I see.
and creating separate lists for daily up, daily down, weekly up, weekly down, monthly up, monthly down on the two time frames. I also have
Yeah.
it set that if I want to add fundamentals in, if I want to do a minimum
Yeah.
PE or a minimum price or maximum price, I got those parameters I can filter the
Mhm.
list by.
And then for managing, you're saying you're just checking whether it's in the money or not. That's all you kind of care about.
Well, no, I watch my days to expiry because obviously I want to roll, adjust, or close before I start running out of time. But yes, if one of my short strikes are moving into the money, I want to adjust. If they're in the money and running out of time, I want to adjust. roll
Uh,
them. When I say adjust, I mean roll.
yeah.
I want to take profit when I have profit. So all I'm doing is looking for really, the way I do it is I'm managing losers. And that sounds weird, but really you are, because if you put
Hmm.
on the trade, you put on a short put and it goes up and you collect all your premium, you close the trade. You're no longer holding winners. What I'm doing is holding losers. Now, the beauty of rolling is most of my losers will end up being profitable because I can roll hell eternity to get my profit. All I need is one bounce. After I've collected a credit, every single time I roll, I've increased the amount of credit I have.
Hmm.
When it finally bounces, I collect all that premium and get the heck out. Managing losers sounds like a bad thing, but it isn't. I take my profit because the thing with selling credit is you have a maximum amount of profit. There's no advantage to keep holding it. If I've got $100 to collect in premium and I've got 90 of it in my account, why do I want to keep hanging around risking the 90 I made to make a further 10? I may as well look for a new position. So to me, that's a time to close.
Oh,
And I've got very little premium left in it, no matter the time. I may as well get rid of it and find a new position.
oh, interesting. So you don't actually wait for till expiration typically.
No, very seldom do I let them expire off. I, I figure that once I'm past 50% of the premium, I've actually got more risk than I have to gain. So I start really watching things that have collected 50%. Like if
Uh,
50% is in my account, now to me the risk side is greater than the profit side. So those are stocks I'm going to start looking to manage. And I will close them early, absolutely. If they're a long ways away and all I got is theta to worry about, then of course I'll collect as much as I can. But as soon as I get an actionable signal going against that trade and I've got over 50% of the collection, I close it.
wow, this is very different mentality than I have, which probably says a lot about my ability to trade.
Well,
Yeah,
it's
that's some super interesting
I'm
stuff.
just applying I look at it as I'm just using the logic the market gives me. Reason I like
Yeah.
selling premium is what is it? What is everybody's biggest bitch about options? I see it in the room all the time. It's a common theme. People have been options, and what do they keep talking about? I can't get enough movement to overcome the theta. I can't get enough movement to overcome the theta. I hang on to it, and the theta kills me. So theta is killing everybody. Well, guess what? There's somebody on the other side of those trades collecting that theta that's killing you, and that just might be me.
Yep.
So Rob used to say all the time, right, that options were made for selling. And
Yeah.
from what I understood, back when he was trading, he only did shares, and I think he might have dabbled in futures as well, or traded futures. So for anyone who's sort of a beginner at this idea of selling options or selling premium, what would you say would be like the first three things to learn?
Okay. Good. Very good question. Probably the first thing to learn is in any creative strategy that you can use, the condors, the butterflies, the broken wing stuff, all of the different strategies that are available to you. Remember, the market can go right sideways. You can make profit. It can do all kinds of things. It can go against you a bunch and you can still make profit. Is to learn spreads because everything is built off of spreads. No matter what it is, it's a spread, a combination of spreads. There's the debit spread and the credit spread, meaning, and so to me, that would be the first place to start is spread. Um, the other is the concept of rolling, is that you can roll those things and buy more time. So the idea of a stop loss, I can't remember the last time I took a stop loss. I really can't. To me, it's just something I never really experienced anymore. I don't stop out of stocks. I have no need to. I can just keep kicking the can down the road until the thing turns around because eventually I'm going to get a move in the other direction. Why right now I'm doing predominantly put? Because puts means I'm bullish. And in an up market, I don't want to get caught where I'm way in the money and rolling. And you can do that. If you keep buying yourself time, you're waiting for that once in a lifetime where the stock market actually drops. But when you kick into a really strong down market, then you can switch to the call side. That's just my word of caution. Because remember, when you're short a call, you have unlimited risk because the market can go to infinity. And you then are stuck on that side, and you are either stopping out or rolling indefinitely. But really, I think it boils down to spreads. Learn a credit spread, and learn a debit spread. If you don't know what I mean by spread, what I mean is if I'm going to go long a stock, I can do it two ways. I can sell premium or I can buy premium. I'm buying premium, I'm going to go long, and I'm going to use a spread. I'm going to buy a closer to the money call, and I'm going to sell a further away from the money call. I'm going to reduce my net cost. And here's something I try to get people to look at if you're struggling. Let's say you're buying $100 call because you think the market's going to move up. And you want to buy sometimes you're going out 1 week. If you go out a couple strikes, you might be able to sell a $50 call. That means your net cost is $50 now instead of $100. And if you're going to stop out at $50 anyway, half of the $100 you spent, basically now you just reduced your cost to $50. And if that was going to be your original stop out, you have no reason to stop. You can now wait 8 days and yes, your loss is still $50 if the stock didn't move, but it now gives you 8 days for it to move in your favor.
Hmm.
You can just sit on that thing. That can be today's trade. It went on, it's not working, but I don't have to close it. My maximum loss is $50. Now, if it was too wide and it cost me $50, too wide, let's say they're dollar strike. That means I have 150 possible profit with a $50 cost. That's a 3-to-1 risk reward. And I got 8 days now that I can sit on that trade for it to work. So eventually all I have to do is go up $2 and I'll collect the maximum amount on that spread. And I didn't stop out and I'm now sitting on that thing. My day trade just became an 8-day trade. You want it to move up in the first day and make your profit, but it doesn't have to, and you don't have to get out. And now you're not increasing your risk because you're going to take a $50 stop, and tomorrow you're going to do the same trade. You're still going to take the $50 stop. And let's say you get 4 days in a row where you take your $50 stop. Well, now you've just gone down a couple $100. Well, I can do the same thing. I can put on a $50 call spread, a $50 call spread, a $50 call spread. And now in 8 days, I've lost the same $200, but I've been on the trade for 8 days in order to make it. Now, the other spread is the short side. That means if I think it's going to go up and I want to take advantage of the decaying theta, then I do the same thing. I short the closest to the money put and buy the further away put. So now I'm collecting $50 instead of paying $50. The market moves against me. I'm going to lose $150. But if it goes with me, I only collect $50. Exactly the opposite scenario. And I did say put because I want it to go away from him going up. So I'm going to use the put side to collect my premium because I'm bullish on the stock. And I can now just let time, if it doesn't go anywhere, it just goes sideways or even goes against me, I collect that $50. So to me, that there really isn't one or two or three things. I think it's just I think the spreads are probably the most important thing. If you understand the debit and credit spread, you can build any structure that we talk about, other than the singular options like short put and short call. But personally, my favorite trade is a short put,
So
not
short put.
spread,
So
just
describe
a naked short put.
the naked short put. So
Okay.
what's the structure of that
Okay.
again? You're
Well, a naked short put, I will look at my options chain and I will find my expected move. And I can do that from my chart. Just trust me, the best option traders are good chart readers. The better you read a chart, the better you can be at an option trader. If you think because options are cheap, I can get away with using options to circumvent me not reading a chart, using the strat works beautiful, is wrong because you're just going to spend money on options and just waste it. So what I do is, okay, if I look at the chart and I say, where's my support? Where's my broadening formation? Where's the bottom of this structure? Where's my downside target? I want to get below that downside target. And we understand expansion of range, meaning broadening formation. So obviously you want to be below what we think potential broadening formation will be. And then we sell the put. Time doesn't matter so much. I like to give myself 18 to 50 days of time. The front week decays the fastest, so you can go closer, you can get more aggressive. All you're doing then is you're going below what you think the lowest level is going to be, whatever means you want to use. You can use delta, you can use expected move, or you can use chart reading skills and find that low. Sell that put. That puts premium in your pocket. It gives you the risk is the stock goes to zero, you held the put, you're at risk for all of that. It's the same as being short stock by selling that put. Because if the stock now drops to the floor, that's the same as being short stock because you're at risk for that full amount. Now don't worry about that. I'll explain something else about that. So that's the simple structure. Just short the put below the market. You want it to go up. When it goes up, you've got delta, theta, and IV going in your favor. IV gets less as the stock moves up. Theta means the time is decaying away on you, and the move of the stock is the delta, and it's all being paid to you to collect the premium you keep the premium you got paid to put on the position. Let's say the stock turns and starts going down. It starts moving towards your strike. This is where the roll comes in. You can take your position and you can roll it out in time. You can roll it further away from yourself also. So let's say you shorted a 50 put. The stock is moving from 55 down to 50. When it gets close to 50, I can roll it down. I can roll it out in time, putting more time in my favor, so I get more time for the stock to work, turn around and go back up, and I can collect more premium, always for credit. Every time I roll is for a credit. If I can't do it for credit, that's the time you're going to take a stop. You may as well get out of it. You want to increase the amount of money they're paying you to hold the trade. So you roll it out, giving yourself a credit. If I can roll it out in time and to a lower strike, the 50 to the 49, and it's still a credit, well, now I've bought an extra dollar of movement. And if it approaches 49, I can roll out to 48 and further out in time. As long as the criteria is, as long as they're putting a credit in my pocket, I'm not decreasing my potential profit, I'm increasing my potential profit. Eventually, when the stock bounces, I collect all that extra credit I was receiving in my roll.
That might be the best.
There, that was probably a lot to
No, that
swallow.
that might actually be the best explanation I've ever heard of that. Thank you. That was good.
You're
Yeah, it's
welcome.
great.
Okay, so when I say advanced options, really what I'm talking about is taking advantage of the other side. Even think as simple as I'm buying calls in an up market and I don't seem to make much money. Why is that? Well, consider just spreading that thing. Just buy a call spread and buy yourself enough time to give it enough time to get into the money and see if that changes your whole prospect. It settles your mind down. It brings you down to a calmer level. You know exactly what you're going to lose because when you built the structure, it is your stop loss built in. No stop losses anymore. You get to hang on till the stock moves in your favor. If it's not working for you, maybe you're not buying enough time. But you've got the advantage of that short side to pay you back some money. So now you can change your whole mindset when you're trading and just calm yourself and hang on and take advantage of it. That's the first place to start. Just making debit spreads. Then you actually were selling some options in there, which now gives you the mindset that okay, I can buy them and I can sell them. Because I had to sell one to create the spread. Now you can invert that and start to sell it for a credit when it's moving, on the other side, moving away from you, and you start now dealing with the spread by collecting. Then you get brave enough to say, I understand the roll spread, because you can roll spreads too. You can do the same thing. It comes down and challenges your credit spread. Roll it. Roll both legs. Roll long in the short, out in time. Give yourself more time. Pick up a couple cents in credit and carry on, keep doing it. Now you get comfortable and you can start selling the naked side, which is basically just secured with cash. Because you start to realize it's not as scary as you think it is. Here's the caution to selling options. Be really careful selling naked futures options. Really careful. They work exactly the same way, but what happens in the overnight on futures options is the spread goes miles wide. Miles wide. So meaning that if it's trading $10 and 10.50 between the bid ask on a given option, overnight it might go 50 cents and 10.50. Well, all of a sudden you've got this spread that's relying on the spread between your long side and your short side. And if it all of a sudden goes from 10 to 10.50, that protection that you've got for your buying power has just disappeared in the overnight session. They're not even trading. The options market's not even open. But the spread in the quote system goes miles wide. All of a sudden you get a margin call because the spread triggered the margin call because you no longer have any money there. It didn't even trade. It can't trade. The bell rings in the morning, the spread narrows up. Boom, you could have closed it for the spread. Everything's exactly as you prescribed, but what happened is that overnight thing triggered a margin call. So I really, 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 really say that is, trading futures options to me sort of it's sexy because there's lots of money there, but it's definitely where the danger can come in. So be really, really, really careful there. I'm not saying don't do it. I'm just saying be really careful. And you
Because
do not want to know how I know that and how much it cost me. And I guaranteed I could have bought a PhD for what I lost in one night.
that's a sad story. I'm not sure I want to know. And that's actually the basis of this next, I guess, bit is I as a trader and even getting into options and whatnot earlier on, we're conditioned to believe that options are dangerous, and if you don't know what you're doing, you're going to lose your shirt. And so when I learned about that, I thought, okay, well, it's obviously it's when you're going short an option instead of long an option. Long an option, the most you're going to risk is your premium. So if you're short an option and you don't know what you're doing, then you could potentially get stuffed, right? So that's
Hmm.
really
100%. 100%. You are 100% correct with that. I am never once going to say they're risk free and there's no problem. You
Yes.
here's if you're going to start selling premium for the first time, why say put in a bull market? Because what happens is you only got zero. Like the stock can only go to zero. So if you're buying a $20, if you're selling a put on a $20 stock, the stock can only go from 20 to zero. You're buying it's got to do 100 shares in order to get one option contract. That's 2 grand, right? Here's your worst you can happen to you is 2 grand. Now, not saying if you like I said, I haven't. I can't remember the last time I stopped out of one of my options trades. I have some negative days. There's no doubt when the stock market decides to drop, your account goes a little bit negative. If they're not challenging your strike, now all you need is time to pass and that premium starts coming back into you. You don't even need the market to go back up. It just needs to stay above your strike. So if you realize, oh, geez, that's just a few $100 or whatever it is, on that stock, not a big deal. Time will pay me back. You just sit there and pray that days click by so you can get your money back. But that is the risk. The risk is 100% that you blindly put on a short trade and just ignore it. You can be assigned also. So you're short a stock, you're short an option, short a put option, and when they the stock market is moving down and they put you that stock, and now you are long a stock in a dropping market. So you're now got the full risk of being long in a dropping market. Um, so you got to be aware of what you're holding. You've got to make sure you understand what you're holding and know how to handle it. But it's not as scary as um, I don't know. I don't know how to. I don't want to. I don't want to detune the potential risk, but I don't want to increase it either. To me, it's the most relaxing way to trade. 100%, 70 open positions, probably more because I put a bunch on this week. 70 open positions, no concern in the world. All I can do is watch them on a daily basis and adjust them accordingly. The first time you do it, little scary. 100% will agree to that. First time you do it, you're going to get a little bit intimidated by it because you're not sure what to do. You don't know sure how it works. You're not all, you know. But I think blindly buying calls or blindly buying puts, thinking that because they go up when the stock market drops or they go up when the stock market goes up, and you just keep feeding premium to the market without knowing what you're doing there is just as risky because every day you're tossing money out of your account. And then I mean, once you figured it out, it's fantastic. You can make a bunch of money and it's nice, but for sure, buying them can be just as risky as selling them because they dictate to nothing. They're not forever things. They've got a timeline, an infinite timeline. So, happy to talk about that more if we want to.
So there was a
The
question in
secret
the
is the
chat.
role.
There was a question in the chat, sorry to interrupt, which was how much would you recommend someone start with in terms of an account size, maybe, um, for starting some strategies?
Well, if you can afford to buy a call and say, okay, I'm going to buy a couple $100 call, or I mean, I got a couple $100 in my account. I'm going to buy a $50 call that costs $50. You better be going into that thinking I can lose the $50. You might still stop out early and cost me $25. So I'll have a $25 loss. If you've got an account of that size, you could spread that $50. You could find a $50 spread. And you could technically do it with a few $100 in your account. Where I'd recommend, and I don't think anybody should be, walking in and trying to trade the stock market with a couple $100 account. It's just, I mean, if that's the only $200 you got, you're probably highly undercapitalized to be in the stock market. But that's where some people got to start. A few $1,000 will get you a nice half a dozen positions in the market. But at a couple $1,000, nothing naked, always spread, always have controlled risk. You got 5+ small stocks you could look at selling premium, selling naked premium. But again, limited amount. You want to make sure that you're not relying on margin because that can get pretty aggressive on the margin. So if you're selling a $20 stock, selling puts on a $20 stock, make sure you got 2 grand in your account. So you can buy the stock if you had to. Now, if you can collect $10 every 30 days, or collect $100 every 30 days on that $20 stock, I don't know if that's possible. Probably. We'd close. Let's say 10%. So you got a $20 stock, you're collecting $20 every 30 days. That's 12 times 10. That's 120% on your $20 investment. So you're making $240 on $2,000. That's 10% a year. 12% a year. Not bad. We're doing nothing other than just once a month putting on a new trade.
Can I ask a question about the rolling? You mentioned multiple times that you can roll a credit spread. I tried credit spreads a few years ago. Some of them were successful, some of them were not successful. And I stopped doing that after I lost 40 grand in one day. That was a sad story. But I noticed that rolling a credit spread is actually for credit. It's not so easy because typically the short leg gets more expensive faster than the long leg when you have underlying moving against you. So you end up.
Were you in the money on the short side?
Yes.
Okay.
Is that the reason?
Probably the reason. You also got to watch what's happening to IV. So you got to watch your earnings cycle to see whether you're getting into the front end of earnings. If the IV is increasing on the shorter dated one, and then you've got a lower IV on the longer dated one, then you're not going to necessarily get it for a credit. The other is look at your volumes and your open interest. You're going to have a harder time when your spreads are wide and your volume's low.
Mhm.
Because if you got higher volume, you can get it done. Yes, it can get tougher. The other way you can do it is you can do it individually. You can pull them apart,
Mhm.
close it, and then buy it without an actual roll. It's the same thing.
Mhm.
Just close one and then go out
Yeah.
and open the other one. Or close like roll the short side and roll the long side. You can get creative to do it. The thing of it is, you got to look at it. If you got in low volume and you say, close my two-legged option and open my other two-legged option and do it at a given price, you're asking a market maker to do 4 transactions at a given price.
Mhm.
And he may be
Yeah.
sitting there going, no, I'm not going to do that. I need 10 extra cents in my pocket to do it. Now that 10 cents could make or break the roll for you. But because he's got to now do 4 legs of transaction, the market maker sitting on the other side kind of holding out on you.
Mhm.
You're going individually, sell one, buy one, sell one. Now you're only saying, take my one transaction and move it out in time. Take my other transaction and move it out in time. Now those will fill a lot faster, especially with volume. You're really careful of volume. Open interest is, if there's no action on it, it's going to kill you on the spread. Look like when you're doing short side, you want the highest open interest, highest volume stocks you can find. So that eliminate some of those meme stocks that you're looking at. There's a few that have
Yeah.
great open interest, and there's some that are just killer, like 100, 200. That's not enough. You're not going to find
Mhm.
enough people or enough market makers on the other side to close that transaction on you. And then to
So
get
you're
out of it, your
uh,
spread's got to go. You've got to adjust your spread.
so you're saying that if you have a spread, if you feel like you need, well, in order to roll it for credit, it has to be out of the money. Like the short leg needs to be out of the money. Is that right?
It's going to be better to do it while it's out of the money. did you have left before you started to try to make the roll?
Okay.
Any idea?
Sorry,
How many
what's the question?
days to expiry?
Oh, well, it's been a while since I've done, but I'm typically there like a few days left is when
Okay,
this one.
there it is. That's going to be the biggest factor in this whole thing. Roll
Ah,
that sucker before you've got 15 days left in it. Don't get
oh, I
under
see.
15 days.
Oh, okay.
You get
That's
under
good to know.
15 days, then the volume will start drying up on you. Now your spread's got to widen up to get out of it. Most of my rolls are happening prior to 15 days on everything, any structure I have. If I got to
Mhm.
roll it, it's going to be in that 18 to 10 days. Like it can be done. 100% it can be done right to the last minute. But if you've got multi legs, you want to roll them, get them done before 15 days. Well, 15 days are still on the clock. That's why the first time we talked, I said, short your stuff at 45 days, and then I want the roll done before 15 days. If you're less than that, just keep it simple. Just short the put, short the call. Watch your spreads because under 15 days you're gonna have a real hard time getting out of spreads.
Mhm. Yeah, that explains a lot of the problems that I've had in the spread before. Okay, thank you.
Okay. I don't know if anybody understands. I use a lot of different terms and I do a bunch of different strategies. So really, you can look at options to if the stock is sitting absolutely still, if you think it's going to hit a target and be there on a certain date, you can be bullish, you can be bearish, you can be neutral, you can be target orientated. There's structures to fit any one of those parameters. So, we can talk about any of them that interest you. I like the calendars around earnings. Um, I'm not a big fan of straddles and strangles. They work. They're great. You can get really aggressive with rolling because you can roll towards the movement. Um, Personally, I find they tie up a lot of buying power and they kind of negate chart reading. But they do work. And if you want to, you can get pretty aggressive with them. What's nice about a straddle or strangle is if you're selling the premium, they don't increase the buying power to put on the other side. So, example, where they come in for me is if I'm short a put, stock moves totally against me. I see that in the chart. I can now sell the call and didn't use one really any more buying power. I start the call is moving down. I can roll that call towards the strike, even without time, just roll it in strike. I keep collecting that premium. As soon as it turns to go back up, I can get rid of the call. I'm still short the put, and I use that trade, that aggressive active trade, to cover the losses I'm making on that put. And when it turns around and moves up, I've got the premium on the put to collect, or I can roll the put out in time. So I kind of use strangles and straddles aggressively, not passively. Anybody doesn't know what the straddle or strangle is? It's using a call and a put at the same time. A debit means you buy the call, buy the put, hopefully that it moves enough in either direction to pay for it. Or a short straddle or strangle is selling the call and selling the put. And straddle is at the money, strangle is some distance out. It's a wider structure.
Do you have any, or do you know of any books you would recommend for newbies to start with? I mean, I've got one called Options Made Easy, and then years ago somebody gave me, it was like this twice as big as a university textbook, Options as a Strategic Investment by Macmillan. And yeah, I've got like the
Okay.
fourth edition of that. And I looked at that and I thought, no, I'm too lazy to read through that shit. I'm not going to bother with
That
that.
doesn't
But
seem like much fun.
exactly.
Yeah. Yeah,
Do you know of any
it's like
books or
Neeson's
even
candlestick book.
YouTube series or something like
Yeah,
that?
I was gonna suggest that there's some very good websites to go. I haven't recommended any of them for a while, so I'd have to look up what they're offering. I'm trying to think of names offhand. I can't think of any books right offhand because I haven't looked at books in quite some time. Um, the the CBOE, Chicago Board of Options Exchange, has some very good information inside their structure. So you can actually look at all just about everything I've talked about will be in that website of some form without, and now you're looking right at the exchange as opposed to an individual's bias. Um, I know Toss and Tasty Trade both have great information. Um, like Thinkorswim or TD, well, I guess it's Schwab now. I imagine they still have all that information on there. I don't know about Schwab. That didn't come through very well. I've not talked about us.
That's all right. Yeah,
Um,
I got him muted.
yeah, so I will, let me, I can't think of, I think this one, let me just do a website here.
I think Investopedia has a pretty decent one too. And it's brief.
Investopedia.
Um,
Yeah, Investopedia is not
okay,
bad.
Optionetics, I think is probably pretty good. It just was a name that popped into my head. I'll post it in the room
Optionetics. Yeah,
here.
I've heard of them before too.
I put them in the room.
Oh, nice.
But yeah, I refer people to the CBOE website just to get a good understanding of what all the different structures are.
Oh, this is cool.
Um,
Yeah, this is cool.
can I ask
This
what?
is a good site. Go ask your question.
Yeah, I want to ask another question. So, because nobody else is volunteering questions. Um, there are butterflies and corners, and there are like iron counterparts to those. When would you use one versus the other?
Let's say the first
Like,
one, you said iron condor and what?
like there is a butterfly, there is a condor, and then there is iron
Okay.
butterfly and iron condor, where you basically use both puts and calls at the same time.
Yeah,
When
okay.
would you use one versus the other? Like iron
Okay.
versus, I guess, regular.
A condor is a debit is a debit trade. An iron condor is a credit trade. Basically the same structure, just reversing
Oh,
the strikes to create a credit or create a debit.
yeah. Oh, I
Butterfly
thought it
is
was.
again the same way. Go ahead.
I thought it was like there was one you can do for credit and one like you can buy or you can sell it, but in one case you do puts and calls, and in the other case you do just calls.
Oh, butterfly is one side. Butterfly is I create the structure out of all calls or I create the structure out of all puts. Condor is using both. Condor is basically a
Oh,
strangle. So really, I muted that mic. Um, so a strangle is you're selling a call and selling a put. To do a condor, you now turn that call and put into a spread. So now if you're doing for credit, you sell the call, sell the put, and then further out, creating the wings of the bird. You look at the structure, it looks like a wing or like a bird or a bat. You're
mm-hmm.
selling the call and selling the put. See, what you've done is traded a call spread, a credit call spread, and a credit put spread. That now becomes the condor. Now I don't know if that's a credit condor or if that's what they call the iron condor. Iron condor might be a straddle. That might be correct. An iron condor might be a straddle where you're selling the wings, and a condor is the principal that you're selling the wings, and then they're either debit or credit. Generally speaking, a condor is done for credit. Um, I think that's what it is. I think iron condor is a straddle, meaning that you're at the money, and the regular condor means you've got some distance between the spreads and the actual price of the stock. A butterfly is a little different. A butterfly is a credit trade that you pay a debit for, and you end up with a long, two shorts, and a long. So let's say and I do a lot of butterflies. I like the butterfly trade. I don't care so much for the iron condors. I think that, again, how can I describe them? Um, I guess I read the chart more. I'm using the chart more to my advantage. So if I'm just saying I got a high implied volatility and I want to collect that premium, I sell a condor because I really don't know what the market stock's going to do. When I look at a chart and I'm going, right now it's going up, right now it's going down, or this is the potential change point. As chart readers, we have that ability to look at the thing and say, we got to signal the downside, signal the upside. So I'm going to take the side. I'm going to be on the direction I want. Doesn't mean you can't do them, but to me, I just don't do a lot of condors. Um, I got too much management for the amount of money I'm going to make. Butterfly is a really interesting structure. I can take a really expensive stock. I can take a $600, $1,000 stock. I can say, okay, this thing's going to hit the top of that mother bar, and I think it's going to do it in 6 days. So I can go out 6 days. I can buy a out of the money call. I can sell further out of the money calls, and I can buy now another further out call. What happens now is I create a ratio spread with the protection of the last call to stop me from getting unlimited risk to the upside, which would be like a naked call. When the stock moves up to that, if I put the short right around where that top of that target is, and use mother bar, but wherever the target is, if I put the short strike right about that target spot, and I nail it on the days, I collect all that premium, and I've got the first long side in the money, and my protective one decays worthless. So I can spend $50, $100 on a butterfly that has a $400 potential gain on a $1,000 stock, and that's really what I've tied up. Is the whole amount of buying power is $50. My account is deducted $50, and I spent $50. That's my stop loss basically. I've got a potential for 450. These are just random numbers. It varies. I got a potential for 450. I spent $50 on it. I can hold it right to the time of expiry, and the max I can lose is $50. And I'm now in $1,000 stock with a $50 risk on it. There's no other structure I can do that with and have that kind of upside with that small amount of expenditure. It's a great way in a small account to trade big dollar stock.
I can't believe that actually made sense. I understood that. That's wild.
Wow.
Yeah, thank you. Do
I
you
didn't
have
know
any
anybody was
expensive,
going to get that, but that's good.
are there any like $1,000+ stocks that you typically like to play with, or
Well, what's Netflix these days?
hmm,
Netflix, $1,200.
good
Yeah,
point.
so spies. That's 600, but I mean, still, if I'm gonna,
Okay.
and see, I guess here, let me sort of condition that a little bit. I'm old school. I come from the days that when you were in the stock market, you did it in 100 lot increments. You didn't buy one stock, one share. When the phone apps came out and started offering shares to the general public, one stock or one share became kind of normal. for me, if you couldn't do 100, you didn't do it. So to me, I think in hundreds. So to me, I'm looking, a $600 stock. Do I want to tie up that much money? Because I'm only thinking in hundreds. I do that for two reasons. One, I'm conditioned that way. And two, without 100, I can't trade options around it. So if I want to own a stock, I want to do it in hundreds so now I can cover call it. And if you don't understand what a cover call is, I can go over that too. But I want to be able to cover call just about everything I hold in my portfolio because I want to increase my return as I'm holding that stock over the long term. So I think in hundreds.
Okay. Thank you.
Yep. That's why I never play Netflix now.
Yeah, booking is another one, absolutely. There's a few. I mean, even a $400 stock or a $300 stock, they can get expensive. And if you really, I'm not 100% want to be actively trading the stock, but I want to take a position on it because I think that here's a good target, but I don't want to have to sit there and nurse it and babysit it and stress about it. If I can put it on for 30, 40, 50, $60 and I've got a decent upside on it, that's when I look at a butterfly. I do not have to collect the full amount. If I got a $400 upside, a $50 cost, and the stock moves towards that butterfly, and goes up by $200, I can close that whole trade. I got a $50 cost. I collected $200. That's a really good return. You just got a 400% return on your investment, and you did that in 2, 3 days. Those are the trades that you put on with less time because you need them. You need theta to kick in order to collect all that premium. So that's a premium play. Where the condors are a very passive. You don't really want to challenge because you run into that rolling the spread issue. To me, a condor is something you want to put on a stock that's kind of moving sideways. Like a great example. Look at Apple over the last month. Had you done condors on Apple, you've probably collected on both the put and call side for the last month. That have been a great condor trade. I think a month, but at least the last couple of weeks. Would have been a great condor trade. Um, and they decay at the rate of theta. So they pay every single day they're paying to you. Where the butterfly kind of holds its value to the very end. So butterfly maximum profit comes in the last day you hold it. Condors decay the theta rate on a daily basis. So it's very easy to collect 50% of the condor and move on just with a few days of decay. So every structure has its unique purpose and used for their unique reason. Butterfly, I can blow the two spreads apart because all a butterfly is a debit spread and a credit spread joining together on the short strike. I can blow them apart. I can roll half of it. I can close half of it. There's many things I can do with it. I can also now do ratio spreads. Ratio spread's an interesting, very high credit spread. And then I can protect it by turning it to a butterfly. So all I do is buy one more leg on a ratio spread, and I've now butterflied it, capping my potential loss. So the thing that I don't like about common information you're going to get in the marketplace by going to websites or going to books is everything seems to be cut and dry. Here's the structure. Here's how you use it. Here's the structure. Here's how you use it. I think of them as dynamic trades. How can I change this, manipulate this, roll this, adjust it to suit the parameters of the market now? They're not condors, they're spreads. Spreads are just individual. So I look at them from their component and their combination so that I can adjust them as an individual option, not as a unit. And I will look at breaking them apart, adjusting them to suit my needs. So just It's just a different way to look at them. And then I have a tendency. We use names to identify what they are. So if I give a name, you can visualize what the structure is. But I think those names create a false impression that we're stuck with that thing for the duration. That's not necessarily true.
That's where the nuance comes into play, right? Is if something happens, then you have these repair strategies or adjustment strategies to, and all of a sudden your position goes from one animal into another animal.
Correct. Yeah, absolutely it does. Yeah, and then not being afraid to do it and understand what you've what you're doing by doing that. What am I making, how am I making this better? What kind of market condition am I adjusting it to? Um, am I making it better or am I making it worse? Sometimes we make them worse. You know.
Next time we gather, I'd
And
really
see,
love to learn about the repair strategies and like if this, if I put on a spread, um, and I've caught a bunch of different things that I think are, I've just made notes on, which is, like you want to roll things before 15 days or at least 15 days so that you're not stuck with a liquidity issue, different things like this. So I'm gonna make a bit of a, I don't know, cheat sheet or at least a question guide to say, okay, like how do we actually apply this knowledge now? And then as a situation changes, what do we do to repair or roll? Or you can roll by time, you can change your strike price. Like there's lots of really good content here that you've shared with us. It's good stuff.
that sounds good. Anybody, I'm open. Like if we're in the room and you want to attempt one of these strategies, you're in a strategy and want to talk about what to do with it because or like something's going on in your trading and there's something you can do to adjust it to help you. Don't be afraid to just reach out to me in the room and talk. We can jump in private or we can do it right there in the room. I know that I talk stuff that isn't really about what's going on in the strat, so I don't like to burden the room with it. So I'm happy to go out private and do it, or even jump into the community stream so others can join in. But I'm open. Like don't don't be afraid to ask me to help out during live trading so that you can actually get real live quotes and quotes that are happening at the time because I can talk this stuff, but until you're actually hitting the thing in your platform and saying, "Oh, there's my spread. Oh, there's like what's actually happening," it does change when you're live because it's the prices are moving, the options prices are changing. Why did this spread not get a credit, or why is it getting a credit this time and not last time? Those are real life scenarios. What we're talking about in here is great foundational information, but it's not the real life.
I would really advocate that those type of questions be posted in the room because, like, yeah, it on the surface looks like everybody is just doing straight on, like stocks and options, like longing stocks and longing options. But then I looked through some messages and like there are apparently like quite a few people that we have who do those type of uh, setup plays. So it would be very beneficial for everybody to have those discussions, like
Okay.
in a big
Okay.
room.
Well, I'm happy to do it anywhere. Now, why am I qualified to do this? I traded my first option spread in 1986. So, and I've basically been a full-time trader for about 30 years. So I may know a thing or two.
That's awesome.
It's amazing.
Well, I think
Yeah,
what's
my
really
first
amazing
options
is that
trade.
what I really think is amazing is your willingness to share your
Yeah.
knowledge.
Oh, absolutely.
That's hard to find.
100%. Thank you.
Well, I enjoy it. I enjoy helping. I learned the extremely hard way. There was no chat rooms, there was no mentor. I learned everything the real hard way on my own, struggling to learn things. So I really think there's a whole bunch of pitfalls one can avoid by having somebody like me helping out. And that's all I do. If I can save you a few $1,000s in learning costs, then I'm happy to share that knowledge and save somebody. Because Sarah, I think it was Sarah, put it very brilliantly once, and it just really struck a chord to me. She says, if we don't help people make profit in trading, then we won't have retail traders, and then we won't have volume, and it'll affect everybody in the market. So it's kind of we owe it to the market to make as many successful traders as we possibly can. And I give her credit for that because I never really thought of it that way until she said it. And I'm going, good for her. Like, good way to look at it. And so I've jumped on board and I will help out where I can. I do not want to step on, anything of this room or the Strat's toes. So I don't talk about kind of the other things I look at outside the Strat. Isn't a lot. So there's some secret I got over there that I'm hiding. I have mentioned I look at volume profile, so I tie that into it a lot. But there isn't a lot else other than that I look at. And I am a
Actually, I think the
very
room is.
strong volume profile proponent.
I think actually the room uses quite a few, like depending on the person. Like we have a lot of people who use different extra stuff. I don't think this is being kind of frowned upon or anything like that. So
I agree.
a bunch of people use EMAs, VWAP, and all that stuff, and
Yeah,
you know,
but I think that if I'm gonna come in here and do community streams, I want to stay congruent with the theme of the room. I don't want to
yeah,
start,
sure.
Well,
teaching something.
this is
This,
what like I'm saying is to understand that the strat builds price and time into the signals, right? Like that's what magnitude is. That's the broadening formation, right? So to be able to see that and then use your advanced option strategies to structure a position that you don't have to like because one of the requests and this is how I'm going to tie it all in together, into a request to Alex and Sarah to the the goal that I have is to at least get a channel in our community here for um, options strategies, and it'll just be like my request will be just to have an open room in the in the free side of the Discord where whoever wants to learn these sorts of things, because they always get questions on what about the people who have day jobs, right? And so
yep.
you're opening possibilities here for people who can't sit at the screens and just buy calls and puts and then exit,
Yep.
on a reversal against, right? Like I think that options strategies really lends itself well to that
Mm-hmm.
underserved part of the strat, which is I want to trade options, I want to use strat principles, I have all that information available to me, but I can't sit at the screen for, you know, 4, 6 hours a
Mhm.
day. So I don't
Right.
think that
And
this is going to be a problem. I really think, that Alex and Sarah will hopefully see the value in having, and rather than clogging the free chat. I mean, my suggestion is I think we should start with just asking questions in free chat and then complain to Sarah that this is getting too crowded. Can we get our own channel? And then
we'll let the other guys complain.
yeah, that's true.
The ones that don't want to hear about it, let them complain.
That's a cool idea.
And they'll say, oh, well, we got to get you guys out of here.
Yeah, yeah.
But
That's a
if you
cool
notice in the chat, I'm placing more of my trades, I'm putting my structure, and then I'm just keeping quiet about it. And if you want to ask questions there, if you want to ask questions privately, sometimes we don't even know how to ask questions about what I post. And then we don't want to feel stupid in the room by asking a question about something I post because maybe I should know that, or so we're all different. Some don't give a shit. Some are intimidated by going in the room and asking a question about something I post. But I will keep posting trades. I will post my adjustments on my trades. Not all of them, but I will keep throwing ideas out there. My posts in the room when I put a trade are really a probe to say who's interested, who wants to ask me a question, like really, they're not about, oh, look at me, or this is what I'm doing. They are who's willing to engage with me because I posted that. That's what I'm looking for. I'm looking for engagement when I post stuff.
Hmm. Cool. Cool. Well, I have personal reasons to make sure that I learn this stuff properly. Um, just because, when I first tried to learn it, it just went over my head. Probably the 10th time I tried to learn it, it went right over my head. And I did spend some time, doing this sort of thing. But I'm also, I know the way I learn. I'm a slow learner, but I'm also a visual learner. That's why I actually started, you know, pulling up some Google images here, right, of like what things are. And, I've seen these diagrams of the, the payout sort of diagrams, and you know what I'm talking about, right? Like these weird
Yep.
V shapes
Yep.
and whatnot. So all of this is starting to come back to me, and now I'm starting to like, when you revisit information, it speaks to you differently. You're like, oh yeah, yeah, I remember this stuff. And so I personally have, you know, um, high motivation to learn this stuff, and I want to make sure that it's done right.
Well, that'd be the next step for these rooms is to add those visual aids. Because I know when I started, the 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 V's and the Z's and the W's and all that stuff, the risk curve graph, it helps you visualize what you're doing. So that'd be a great visual aid to add in our talk and talk through a structure and where the profit is and where it is at expiry, where it is today. I know Thinkorswim actually does a really good job of that. I no longer have access to it because me being a foreigner and Schwab took over, they kicked me out. So that was really nice. Right in the middle of having a portfolio full of trades, just the next day, I was like, "You're gone." So I love Schwab now. And
That's
TradeStation did
crazy.
the same thing to me. So
Cool.
Wow. Just like that, huh?
yeah, they didn't give
Mhm.
us any warning. It's just one day you couldn't log in. Well, what is it?
Oh
Well,
wow.
Crazy.
you're set on close only. You can only close. I couldn't roll. I couldn't do anything. Everything was
Wow.
on close only. And the only thing you got to do was wire your money out. Like that was your option. Close your trades, wire your money.
That's crazy.
That's crazy. Yeah.
Yeah. But so if somebody opens a Toss account, because I know Toss very well. I got about 2,000 scripts wrote for Toss. Um, if somebody opens a Toss account, put 50 bucks in it, throws me the password, we can open it in the room and we can put all these structures there visually on the screen.
Cool.
Oh, I mean, we can. Yeah, we don't need to
Or
open an
make it,
extra
yeah,
account. Like we can. Yeah, I can
yeah.
volunteer.
I think I have one. Let
Yeah,
me
just
see.
put your account up and they'll tell you what to click and you click it, boom, we can look at it visually. They've got a very good system for
Yeah.
looking at them. There's others out there too. Some
Right.
aren't so great, but I'm very familiar with the Thinkorswim layout of their options risk graph.
Yeah. But maybe next time then I'll make sure that I'm in the room and I'll have it up. I'll switch it to like a paper account so that it's all easy to and risk free to do, and then we can or do it on demand stuff.
That'd be cool.
And I think that'll help people a lot to see
Yeah.
it visually.
Yeah, yeah, yeah.
Because
Yeah, I have no
sometimes
problem. I'll need to figure out how to show my screen, but I'm sure Solanke will teach me.
I think that I think just down at the bottom there, isn't there screen share? Yeah, share your screen right there in the bottom left.
Yeah,
Yeah,
I'm joking.
just yeah, he knows what he's doing. He's just fucking busting my balls. That's all he's doing.
He knows me well.
Okay.
We're going on
Well,
to an
any
hour and
more
a half now,
questions?
guys.
I mean,
You want to wrap it up?
I got nothing going on, so I'm in no rush. So if anybody wants to keep
Yeah.
asking questions, I'm content to stay.
Oh,
Is our market closed?
Yeah, markets are closed now, and they will be tomorrow.
yeah.
And we're back at it Monday, I guess.
Monday. Yeah.
Right on. I got to run, but Ali, thanks for your time and the Big Easy. I'm really grateful that you kicked us off here with some great questions. That was actually, I think that turned out better than I expected it would.
Yeah, I mean, I can't keep my mouth shut, even
Appreciate
when I
it.
try.
Yeah, you
Thanks for
just gotta
answering the
hide yourself.
questions.
All right. Thanks, everybody.
All right,
And yeah,
folks,
Yeah,
enjoy the
thank
rest
big
of
you.
your
shout
day.
out for Ali.
Yeah, thanks
Have a
again,
good one,
Ali.
man. Happy
You're
4th.
welcome.
Not bad.
Thanks, everyone.
All right, take care, guys.
Thank you so much.
All right, bye bye.
Have a happy holiday, guys.
Happy
Bye.
holidays.